Today, I'm going to show you how to unlock one of Canada's best kept mortgage secrets to building wealth. The Canada Revenue Agency, or the CRA, calls it rental cash stemming. Now, this is a mortgage tax strategy that can help you save potentially hundreds of thousands of dollars of income taxes and pay your mortgage off years ahead of schedule. This results in hundreds of thousands of dollars of saved mortgage interest over the lifetime of your loan, all while using the government's money and not actually increasing your out-of-pocket expenses. I know it sounds impossible, but it's not. Today, I want to prove it to you. By the end of this video, you'll understand how this strategy can completely transform your approach to debt as well as investing to help you build wealth faster and more efficiently than you ever thought possible. My name is Devon, the co-founder of Freedom 10, along with my business partner Sean Smith. We have a combined 20 years of experience advising thousands of families on how to optimize their mortgages and build wealth faster using advanced mortgage strategies. And we've managed hundreds of millions of dollars in mortgage transactions over our career. And myself, I'm a certified Smith Manoeuvre professional, as well as a rental cash stemming specialist. So let's dive into why we're here. At a high level, rental cash stemming requires a few things. A mortgage balance on your primary residence or your secondary home, like a cottage or a vacation property. A re-advanceable home equity line of credit product on that property. And then, of course, you need a source of rental income. Now, this source of rental income can include a standalone rental property, a secondary unit in your current home, like a basement apartment or a laneway suite, or if you live in a triplex or fourplex, the other units. If you don't currently have a source of rental income, you can consider converting your current home into a rental property, move into a new house yourself, or go out and buy a rental. It's important to note that the source of this rental income cannot be held in a corporation. Finally, you obviously need taxable income to qualify for those juicy income tax refunds we talked about earlier. Shortly, I'll explain exactly how this concept and process works, including other important considerations as well as requirements. But I don't just want to explain the concept. I'll also show you how real people like my wife and I are using rental cash stemming to accelerate our own mortgage paydown and boost our net wealth. Now, our net wealth improvement is over $650,000. And this improvement amount is in addition to any property appreciation, and it's all without increasing our monthly out-of-pocket expenses. Now, let me clarify what I mean by net wealth. Net wealth improvement is not just about increasing the value of our assets or investments. It also includes the money we save on income taxes as well as mortgage interest. So in other words, every dollar we save on income tax or mortgage interest is just as valuable to us as earning that dollar through income or investments. By paying less tax, reducing our mortgage debt faster, and saving on mortgage interest, you're improving your net wealth. So why does cash stemming actually matter? Let's face it, the cost of owning a home in Canada has absolutely skyrocketed. Interest rates are all over the place, and inflation's been eating away at our income. On top of that, Canada is the 5th highest tax country amongst developed nations in the world. We can all agree that income taxes are not likely to be coming down. In fact, I would argue we will see them increasing moving forward. Rental cash stemming is a strategy designed to help us keep more money in our pockets, reducing our debt levels faster and building wealth sooner. I'm not talking pocket change. Many of our clients have used this strategy to improve their net wealth by $800,000 or even more. And remember that this is in addition to any property appreciation. Others have actually been able to become completely mortgage-free in under 10 years. Now, some of you watching this video may feel that the strategy sounds very similar to the Smith Manoeuvre. And for any of those who don't know what the Smith Manoeuvre is, like cash stemming, it's a mortgage strategy that aims to make the mortgage interest on our primary residences tax-deductible. Now, the Smith Manoeuvre focuses on reborrowing the available equity in our home created by our regular mortgage payments to invest in income-generating assets like dividend-paying stocks. Now, this strategy actually keeps us with the same mortgage debt balance over time, simply builds in tax efficiency, and allows us to invest way earlier than we thought possible. With rental cash stemming, on the other hand, you take the money that you're already earning from your rental properties, use it in a much smarter way to accelerate our mortgage paydown and save on income taxes. Now I get to show you how the cash stemming process actually works and how someone can execute it all without increasing their monthly out-of-pocket expenses. But please keep in mind, in this example, this is a very simplified version of the cash stemming process simply for the purposes of this video. When these strategies are being implemented in real life, we need to account for so many critical considerations so that your strategy works and you don't risk losing your potential tax refunds. For instance, selecting the right bank and mortgage ensures that the strategy can work very efficiently. You also need to manage the flow of funds very carefully, from choosing the right bank accounts to set up, in addition to understanding the risks of managing your line of credit. On top of that, we also need the right tools like calculators that can accurately predict and calculate what our potential income tax and mortgage interest savings look like. And lastly, maintaining meticulous records are essential to ensuring everything remains compliant with the CRA rules. Now don't worry, we will dive into these considerations after this example. So let's dive into the example. Let's meet Billy. Billy owns his home and a rental property. Now, before implementing cash damming, Billy's cash flow process, like most real estate investors, was as follows. Each month, he makes the mortgage payment on his home with his salary. He also uses the rental income to make the mortgage payments for his rental property. Now, at this pace, Billy's going to be in debt for around 30 years. At the end of those 30 years, he will be left with 2 fully paid off properties, as well as a source of rental income coming in to support throughout his retirement. This is a fantastic plan. However, with a few minor changes, Billy can actually dramatically improve the profitability of his investment. Now, the first change we make to help Billy start with the cash damming process was actually restructuring the mortgage on his home or his primary residence, turning it into a readvanceable mortgage and home equity line of credit product. Now, this change to Billy's mortgage structure is critical. With a readvanceable mortgage product, as we pay down the mortgage balance, we're going to automatically get access to borrowing room on our line of credit. Let's talk about the next change we made. Instead of using the rental income to cover the rental property's mortgage payment and other expenses, Billy is now going to use the rental income to make a prepayment towards the mortgage balance on his home. This is going to reduce the mortgage balance on his home faster, creating even more borrowing room on his line of credit on a monthly basis. Now, I know what you're thinking. Now that Billy is using all of the rental income to pay down the mortgage on his home faster, how on earth is Billy going to make the payments for his mortgage, as well as all the other expenses for his rental property? And this is exactly where that new line of credit comes into play. Every month, Billy gets to borrow from his new line of credit on his home to cover the mortgage payment and all those other expenses for his rental property. It's important to note that as that line of credit balance grows, there will obviously be a minimum monthly interest payment that comes due. The best part of the strategy is it's designed to allow Billy to borrow from his line of credit to actually cover its own interest expense payments. So monthly out-of-pocket expenses don't actually increase. Now, the goal is to actually pay down his primary residence mortgage as quickly as possible, effectively shifting the balance of that mortgage on his home over to the line of credit. Now, once the mortgage is fully paid off, the focus then shifts to aggressively paying off that line of credit component. Now, it's a fair question to ask why this process has anything to do with our income taxes. And this is really the secret sauce. Since the borrowed funds from the line of credit are used to cover the costs of a qualified investment, his rental property, the CRA now considers this debt balance a tax-deductible investment loan. This means that the interest becomes tax-deductible against his personal income, which can result in significant income tax refunds over the lifetime of the mortgage. At the end of each year, the balance on Billy's line of credit has grown, and the interest that he's accumulated throughout the year is added as an expense on his income tax returns, which in turn reduces his personal taxable income, generating those income tax refunds. Now, we at Freedom 10 advise Billy to take those income tax refunds, pay down the mortgage on his primary residence years ahead of schedule, resulting in significant mortgage interest savings. But that being said, there really is no requirement that you do this if you implement the strategy yourself. We have many clients who are simply using those tax refunds to maximize their lifestyle. It is important to note that you cannot just refinance a rental property, use those proceeds to pay down the mortgage on your home, and now it's magically tax deductible. The CRA tracks why we are borrowing money to determine the tax deductibility. Money has to be borrowed for the purposes of investment to be considered tax deductible. Now let's take a minute to recap the changes that Billy made and why it works. Every month, Billy gets to take his rental income and applies it towards the mortgage on his home as an extra prepayment, paying down that mortgage faster. He is also going to leverage the new line of credit secured against his home to pay the rental property, mortgage, and other expenses. Now, the Canada Revenue Agency now considers the interest on Billy's line of credit tax deductible. And this is all because we are using the line of credit to cover those rental property expenses. As his line of credit balance increases each month, so does the tax-deductible interest amount. Each year, Billy gets to deduct this interest from his personal taxable income, resulting in those substantial tax refunds. We recommend that Billy use these tax refunds every year to pay down the mortgage on his home faster leveraging his prepayment privileges. By leveraging this strategy, Billy gets to pay off his personal mortgage years ahead of schedule, resulting in that substantial mortgage interest savings and the benefit of no longer needing to make ongoing mortgage payments years ahead of schedule. Now, the smart move for Billy, once his mortgage has been paid off, would be to continue to contribute what would have been his mortgage payments each month into an investment portfolio. And in a moment, I'll explain how my wife and I are doing this exact strategy to build ourselves an investment portfolio of around $320,000. Now, can you see the power in this? Can you see how transforming your approach to debt could literally save and earn you hundreds of thousands of dollars? So let's take a look at a real life example, just so you can see exactly how much money someone using this strategy can actually save. As we mentioned before, my wife and I do use rental cash stemming ourselves. We restructured our mortgage and we changed the flow of our rental income. Now, over the lifetime of our mortgage, we will receive an estimated $213,000 of income tax refunds. And we're going to use those tax refunds to pay down the mortgage on our home around 5 years early. Because we've shaved those 5 years off our mortgage, we get to save around $119,000 in mortgage interest. Now that the mortgage is paid off, we're going to reinvest that money we would have been using for our mortgage payments each month into an investment portfolio. And we're using a very conservative estimated 5% return. Our portfolio will grow to over $320,000 in just 5 years. Now for us, that's a $652,000 net wealth improvement, and we did not increase our monthly out-of-pocket expenses to achieve this. As a reminder, the $652,000 improvement is in addition to both of our properties appreciating in value, and it does not consider any rental income that we've received. Just imagine what this strategy will do for you. So at this point, you may feel confident enough that you could implement cash stemming on your own. After all, the concept seems straightforward, doesn't it? Here's the reality. It is a very risky process, and the devil lies in the details. For example, one of Canada's largest major banks only allows you to use your prepayment privileges once a year. Now, this can completely throw off your entire strategy and put you in a really difficult financial position if you don't have the tools to manage it properly. There are also very specific rules around mortgage products, the segregation of funds, and bank account structure. If handled incorrectly, will lead you to a failed CRA audit, requiring you to pay back your tax refunds and penalties. So that's why working with professionals like us is so critical. We do more than just explain the strategy, we ensure it's implemented flawlessly. Our process includes a personalized plan tailored to your unique situation, reviewed by a certified professional accountant, along with expert execution and ongoing support. We also provide tools like a tax refund and mortgage interest savings calculator, as well as guidance on detailed record keeping to ensure that everything is aligned with CRA requirements. Now, our clients have seen those massive returns, all because we handle every detail, ensuring that they maximize their potential tax refunds and mortgage paydown, and helping them avoid very costly mistakes. The best part? Our service fee is tax deductible, meaning that the government gets to pay for part of it. If you would like a recap of everything you've just learned, including an animated map of the cash flow process, as well as a list of most commonly asked questions, click on the link below. Before I let you go, let's do a final recap of what cash stemming is and what you need to qualify. You require a primary residence or a secondary home with a mortgage balance on it that is not currently tax deductible, a source of rental income not held in a corporation, and taxable income. The more you have, the more you stand to gain from those tax refunds. With a few modifications to these components, you'll be able to take full advantage of this CRA-approved mortgage tax strategy to accelerate your mortgage paydown and build wealth faster. Remember, cash stemming isn't just about paying off your mortgage. It's about transforming how you manage your debt to build long-term wealth. If you want to learn more or get a personalized plan, hit the link below to book your complimentary call. We will walk you through every step and ensure that you get the maximum benefits from this powerful strategy. Before wrapping up, I'd like to quickly touch on some of the most commonly asked questions. Aren't lines of credit interest rates higher or more expensive than mortgage rates? Yes, a home equity line of credit rates can sometimes be higher than the actual mortgage rates. Not to worry though, we do work with several banks that offer tailored solutions to help you keep your interest expenses under control. And keep in mind that your annual tax refunds lower your net effective annual borrowing costs significantly. Why isn't everyone doing this? The truth is, many people, including professionals like your accountants, mortgage brokers, and especially your retail bankers, they just aren't familiar with this strategy. It's a specialized approach that is not widely known, and even if your accountant does know about the rules, it can be difficult for them to properly guide you through the implementation, given they are not mortgage experts. That's why we have partnered with a certified professional accountant, ensuring you have expert support from both sides to navigate this process effectively. If we have an Airbnb property, can we use this as the rental income source? And in theory, the answer to that is yes. However, the challenge with any Airbnb property or short-term rental is that the potential for changing regulations and government policies can potentially come into play. So to avoid future complications, we're generally advising against relying on short-term rental income as your source of rental income for the cash damming strategy. What if my rental property is cash flow negative? Can I still do rental cash damming? Absolutely. So rental cash damming as a strategy does not inherently worsen your cash flow. In fact, if you have sufficient equity in your home, this strategy can actually help you cover a lot of those rental shortfalls. It's a flexible approach designed to work with your financial situation and not necessarily against it. Thanks for watching, and I'll see you on the path to mortgage freedom.